A record close for the S&P 500 in sight today in what could mark a third record-making session in a row, if it can turn positive again. Let's get a technical read now on this breakout with Jeff deGraaf, founder and chairman of Renaissance Macro Research. Welcome back. It's nice to see you again.
Thanks, Scott.
Things that jump out to me, certainly from your notes, S&P at 5,800 by year end. So did you recently up your outlook based on what you're seeing?
No, we hit that with escape velocity, which we got in November, and that's part of this combination of 20-day highs that we look at. It was a big number. I mean, it was in the 70% readings, and those are, really a handful historically. And what we know from that data is that the market is generally up a little over 20% from that point, which is, look, it's not a comfortable thing to say, but that was 5,800, and so we said, look, the data is good data. We believe in this momentum indicator, and so we did that back in November of last year.
Okay, when you look at the charts, you're going to show us one that sort of confirms this high momentum market that you suggest we're in, correct?
Yeah, look, I mean, there's something, and I'm an unapologetic trend follower and momentum player. I mean, that just is what it is. So, but there are points where momentum becomes vulnerable. There's no doubt about it. And, being in a momentum market is different than being in a dangerous momentum market. And so one of the things that we look at is what percentile are we in terms of returns for high momentum versus low momentum names. And when that spread gets into the 90th percentile, that just says, look, momentum is working at the expense of everything else. And it really becomes a reflection of the narrative, right? What's the prevailing narrative out there? And that's where we tend to take a step back and say, okay, there's danger here of reversion. We're in the 87th percentile, and I know that feels like it's close enough to make that call, but the data says it's not close enough to make that call for us. So we're on guard, but I still think that we've got several weeks ahead of us that we can stretch this, get us into that 90th percentile, but have us back on. We'll talk about it, but that's the point where we'll get more cautious about the market overall.
All right, booking done. Let's put that on your calendar. Soft booking. Okay. We'll reach out and firm it up. Chips. What am I supposed to think about the chip stocks, which have gone just crazy? And it's not just NVIDIA either. AMD, Supermicro. I mean, I could go down the list with 10 more names. You know what I'm getting at.
Absolutely. And look, this comes back to the momentum idea, right? So there are two factors that we look at when it comes to being concerned about industry groups. One is because in isolation it doesn't matter, it doesn't work. But when the combination hits, it's very powerful, and that is we've had a good run. We're momentum names, so these are reflective of some of the highest performance names. But today, people's expectations are even higher than the historical momentum that we've seen, and we price that through the option market. And when we have that combination of a good historical momentum in these specific names, and then the option pricing is saying we're betting on even higher prices from here, that's the point that we say price to perfection. You can have it. We're going to take our ball, or at least half our ball, and go home and play somewhere else. So we're seeing that in semiconductors. That started about 2 weeks ago, and obviously that can be a little bit early, but statistically it's a meaningful signal, and we're seeing that only in semiconductors here. So that's one area that we'd be more cautious on. You
have been writing some about biotechs too. Do I need to be concerned about what I'm witnessing there?
So just the opposite of what I just described, Scott, is happening there, where we have momentum. And again, momentum in isolation is fine. It's something that we pursue. But we have a lot of incredulousness in that space. In other words, people don't believe it. They're betting against it. And so when we see this, in what we call the incredulous advance, where you have momentum, but people are the sentiment just doesn't really buy into it, that tends to be very powerful. To the upside, the trends tend to persist, and it kind of drags people kicking and screaming into the market. Much like, let me just say that, much like they were doing with semiconductors a year ago, it's just starting to kind of evolve with biotech. So I do not think it's too early. The other part that I would just note, and our clients see this, is our excess return model that we run for every individual sub-industry group was actually some of the lowest excess negative returns that we've seen in biotech over roughly 40-year career. So that's a good starting space, right? In other words, a lot of the excesses have been rinsed out. People have kind of forgotten about it. They've moved on. Mm-hmm. As these are breaking out and starting to show momentum, the sentiment has actually been fighting that trend, and that's a good sign, not a bad sign.
I got to bounce, so I'm going to ask you to be brief in your answer. You got anything on Apple? which is at 175 and obviously has looked ugly lately.
It has. I think it's a really astute observation. It's a big name, part of the Mag 7, and it's the weakest of them all. Google's not far behind it, but it is behind it. I think you want to move on from Apple tactically, right? I mean, this isn't about the next 30 years. This is about the next 3 to maybe 12 months. But it looks to me like it's distributing, and it looks like it's in a elongated consolidation in our view.